Hello, everybody, and Happy New Year. So we're going to kick off the year with an update on a presentation I did 2 years ago on banks and climate change risk management. I've just got a few slides now to provide an update on that, and also some latest pronouncements from regulators that weren't that come after my presentation from 2 years ago. Should be a short video, hopefully. Let's hope I can make to my timetable, my 10-minute limit. Okay, right. So we'll kick off. Climate change could affect the financial stability of the banking system. Absolutely, that's exactly what for a few years from regulators around the world. And just to get us in context, obviously, banks in some jurisdictions may expect to be more impacted either through regulatory compliance or indeed the impact on their economies around them than banks in other jurisdictions. But from the global point of view, it's something that you can expect just about every bank to be involved or impacted by to some extent in the coming years. Just a quick reprise on what we're talking about here. Two types of risk or impacts. It's physical risk drivers and transition risk. Please refer to the earlier video on this topic for more detail on how these two risk types manifest themselves. Now, what is the agenda? First of all, there is regulatory drivers. So a number of regulatory authorities around the world, for example, or indeed not just regulatory authorities, but also the Basel Committee, plus regulatory authorities like the European Banking Authority, the UK's PRA, the Basel Committee, the Monetary Authority of Singapore, etc. A number of them have already pronounced and published guidance on this. There are market expectations, what a wider range of external stakeholders of firms, of banks would expect banks to be doing in addressing this. And of course, there is also business opportunity, and we're going to round off with this at the end of the presentation as well. It's a question of looking at the risk management aspects of this topic, but also the opportunities that arise, particularly with respect to transition risk, as we transition from an economy that has been more dependent on hydrocarbons into an economy that is less so. Opportunities as well as risks arise. Now, what does the regulator expect? Most regulatory authorities have pronounced on what they expect banks to be doing over the next few years with respect to strategy, the governance, the ownership of this area, the impact on the risk management framework, how a bank should be addressing the risk impacts of climate change through their stress testing processes. So that would be incorporated into the ICAP, and also with respect to disclosure, what a bank would be expected to say in its Pillar 3 disclosures. Now, in the UK, for example, there's a particular supervisory statement, SS 319, that talks about this in detail. Different regulators around the world have pronounced slightly differently on this topic. I would suggest that, of course, wherever jurisdiction you are in, you get familiar with your regulators' guidance on this. Where there isn't any specific guidance in a particular jurisdiction, then of course it's always good to fall back on what the Basel Committee has published in this space. So when we respond to this supervision guidance, we're going to demonstrate that we as banks understand the impact on the traditional risk types of climate change. For example, how does market risk, credit risk, liquidity risk, operational risk, and reputational risk, along with a whole host of other risk types that would exist already on the bank's risk management framework, how do we expect them to be impacted through the physical risk and the transition risk drivers? Some sectors, you'll be unsurprised to note, and this is a reprise from the previous presentation from 2 years ago, some sectors are impacted more heavily than other sectors. So if a bank is involved in these sectors, then the impact on them of the transition phase, the transition risk impact, will be greater than a bank that has less exposure to these sectors. Now, let's get up to date then. So what's happened in the 2 years since the last presentation? Just by way of example, I'm going to pick out a couple of points, one from the EBA and one from the Monetary Authority of Singapore. Now, the EBA published some final guidance in 2022, a final report, which doesn't mean they wouldn't necessarily expect them to publish any more guidance on this. But in 2022, they had a final report on this, final guidance on this, and they introduced, amongst other things in that document, which I recommend you have a read, particularly if you're in the European Union jurisdiction, they introduced two new risk metrics that are to be implemented from this year, from the middle of this year onwards. If you look at the Financial Stability Board, they reference this first one, the BTAR, the Banking Book Taxonomy Alignment Ratio. Now, to quote from the Financial Stability Board, this is a comprehensive key performance indicator that shows the overall alignment of institutions' banking book with the EU's taxonomy regulation for the objectives of climate change mitigation and climate change adaptation. Okay, and the rest of the quote you will see there on the slide. In other words, banks in the European Union jurisdiction will be expected to report a beta metric, which would demonstrate to what extent they are moving towards climate change mitigation and climate change adaptation through the business that is on their banking book, in other words, on their balance sheet. And this metric will be, as I've said there, time and resource intensive to produce. Okay, so that's the beta metric. Now, there's another metric that is in the EBA report, and that is the green asset ratio. And I've actually borrowed here a slide that I came across in a PwC presentation. PwC, of course, being one of the big four consulting and accounting firms. I saw a presentation from them that talked about the green asset ratio, and there you have it, there in front of you. Again, that's something that expected to be reported from this year onwards. And as the name suggests, how much of a bank's balance sheet reflects green exposures compared to non-green. And again, that's something you'd expect would take some time and effort to produce. So those two metrics there that banks in the European Union will be expected to report from this year onwards. Now, the Monetary Authority of Singapore published some guidance just later last year, just a couple of months ago, and I've quoted from that as well. There's the link there for that document. This is an interesting one. There's a slide of quotes there from the MAS, and then I've pulled out this quote here in red from an MD at the MAS, from the MD, Managing Director, Mr. Ravi Menon, who said, indiscriminate divestment from carbon-intensive activities will not get us to a net zero world. A large part of the global economy depends on such activities for growth and jobs. Rather, financial institutions must actively support their borrowers, insured parties and investee companies to progressively decarbonize their activities through credible transition plans. Now, there's a lot in those two or three sentences, actually. This recognizes from at least one regulator, if not more, that banks, when planning their medium-term and long-term strategy in response to transition risk, will want to consider that transition over time. It's not an instant process, and moving towards net zero involves assisting customers, particularly corporate customers, in their transition as well. So it's not an overnight thing, it's over time. And this is where opportunities arise, as well as the fact that our recognition that when we enter into transition, or we assist corporate customers to transition, it isn't just about an instant or a short-term change from one sector to another. It's helping the customers in one sector transition to a more carbon-friendly or carbon-neutral world. And hence my extract here from an article I read in The Economist a couple of months ago, where I've underlined some points here in this article. You can see as reflecting, again, mirroring what the Monetary Authority of Singapore was saying in their publication. There are opportunities as well as risks. There are certain sectors more negatively impacted by transition risk, but by the same token, there are sectors in the economy that are going to benefit from the transition to a lower carbon output economy. And so it would make sense for banks, when they address climate change risk, to incorporate the opportunities as well as the risks into their strategy. Now, there are a few slides I'm going to reprise again from last time's presentation from 2 years ago, which is climate change risk and the operating model. I'm going to go through those reasonably quickly. First thing we want to do, here's an old slide. What does the physical risk and transition risk drivers mean for our existing risk types? So on that slide there, down the left-hand column, we see the current types of risks, not a full list, of course, that would be on a bank's risk register. What does climate change mean for these types of risks? So we should understand that, because we'll need to address that in our risk management framework as we adapt our risk management framework to respond to this new risk area. And that's what the next few slides say as well. We will be adapting our risk management framework to incorporate the risk, that the climate change risk drivers, into our existing risk register, and then moving forwards based on that. That means addressing our appetite for the existing risk types in response to how they'll be impacted by climate change. And before I get to my 9-segment suggested text, high-level text for risk management framework, we also need to consider, bear in mind those two EU metrics, beta and GAR, green asset ratio. We need to consider, particularly for corporate customers, what their position is, if you like, with respect to climate change. So Again, from last time, I had a little scorecard, a qualitative scorecard that we could use to assess the green credentials, if you like, or the climate change friendly credentials of all our customers. Again, that is a non-trivial piece of work. A colleague of mine on the BTRM produced this hypothetical example of how we might go about measuring the green score, if you like, of all our corporate customers. And I'm reprising my 9-segment climate change risk management framework with this slide here. Have a look at the appendices to this slide deck for a bit more detail on this. Now, just to say, for those of you watching this video, there will be a link to these slides published alongside as well. Okay, now, what does this mean in practice? Just very briefly now, as this is simply an update, a quick update, what this means in practice is that we will be assessing our current balance sheet for physical risk and transition risk impact, but of course we'll also be we're modifying our strategy, our medium-term strategy, to take into account what our business model might look like in response to climate change. Here is a real-world example of an assessment of a balance sheet for physical risk. So in other words, we look at the current balance sheet loan portfolio. What is the physical risk exposure of that, and what is the transition risk exposure of that? And here's an example just to illustrate what that might mean. How much of our portfolio is impacted in a negative way with respect to physical risk in this particular example, and what that would mean for defaults and therefore our capital adequacy ratio or capital add-on. Okay, quick run through that was then. I will conclude now with this update. First of all, this lecture isn't about a climate change debate. It's about banks responding to regulator guidance, as well as expectation that the global economy plus our individual jurisdiction economies are transitioning to a lower carbon output environment. So we recognize that, and so we modify both our strategy and our risk management framework in response to that. Okay, and finally, climate change risk is to be viewed as important as credit or liquidity risk from a individual bank perspective, and that was one of the things that was in the PRA guidance from 2019. Ultimately, we want climate change risk to be monitored and mitigated and managed in the same way as a bank that we manage and monitor and mitigate all our existing risks, traditional bank risks. When we're in that space, when we're in that space, we're probably in a good space as a bank in responding to all the regulator guidance. Great. Okay, so the relevant chapter in POB is chapter 22. There's a couple of other references there that I would also commend to you. Thanks very much for your attention for this video. Thanks for listening, and I will see you soon. Take care and have a good day. Bye-bye.
Thank you for watching this video. Please have a look at my YouTube channel and subscribe and watch the videos on that one. I'm sure you'll enjoy them. Thank you.